in welcoming Secretary Bessent.
That's fine. Big group. Good morning. It's an honor to be here. To begin with, I'd like to thank the New York Fed for hosting this meeting and inviting me to join you. It's fitting that the Treasury Market Conference is held each year in the fall. Late fall offers us the opportunity to both look back and to look forward. And since the fall of last year, much has changed. November 24 marked an inflection point for the nation and its fiscal future. The American people had just elected President Trump to put the country on stronger financial footing. The previous administration had run up the highest deficit in U.S. history outside of a recession or wartime. As a result, inflation had skyrocketed to generational highs. Families watched our hard-earned savings melt away as prices of consumer goods climbed even higher. Seeking a course correction, voters elected President Trump in a landslide, and they gave him a clear mandate to make America affordable again. My commitment to that cause, to improving affordability and putting our fiscal house in order, is what motivated me to come up from behind my desk in the private sector and to enter public service. As the 79th Treasury Secretary, my duty is to serve as the primary caretaker of the Treasury market. Maintaining a robust Treasury market and even strengthening it further is essential to making America affordable again. That's because Treasury yields set the global risk-free rate. Domestically, the risk-free rate sets pricing for everything from bank loans and home mortgages to stocks and corporate bonds. In that sense, Treasuries are not only the bedrock of the global financial system, but also the American dream. Treasury yields have a trickle-down effect on the broader economy that determines whether a young family can afford a home, a college student can buy a car, or an entrepreneur can get a small business loan. The work we do here directly impacts affordability and quality of life out there, which is why we must succeed. The good news is we are succeeding. The U.S. Treasury market is more robust and more liquid than it's ever been. The Treasury Department has made significant progress in increasing demand and expanding accessibility to U.S. debt. We are poised to make even more progress towards this goal in the months to come. Purpose of my remarks this morning, twofold. First, to highlight the depth, breadth, and enduring importance of the U.S. Treasury market, and second, to outline the strategies we're using to keep it that way. As Treasury Secretary, my job is to be the nation's top bond salesman, and Treasury yields are a strong barometer for measuring success in this endeavor. By this metric, we are making substantial progress in keeping rates down following the spending blowout from the Biden years. In fact, the U.S. Treasury market has been the best performing developed world bond market this year. The Treasury market's total returns year to date are 6%, its best year since 2020. The U.S. 10-year term premium is basically unchanged, while U.S. borrowing costs across all other areas of the curve, from 2-year notes all the way to 30-year bonds, are down year to date. Lower Treasury borrowing costs mean lower corporate borrowing costs, lower mortgage rates, and lower car payments, which all translates to greater affordability for all Americans. Other developed bond markets, by contrast, have had nowhere near the same success. Some countries have seen demand for their debt reduced or even dry up, especially at the long end, and they've had to react by curtailing sales, but not the United States. We continue to see robust demand at Treasury auctions from a wide range of investors, including foreign investors whose holdings of Treasury securities are at record levels. This impressive performance comes in spite of the negative rhetoric and doomsaying of market pundits, especially this spring. For the past 10 months, the press has been pushing a sell America narrative. But the data and the price action have been saying the opposite. Buy America. And the market always rewards those who put fundamentals over fear. Suffice it to say, the Treasury market remains the deepest and most liquid market in the world, which is a testament to the efficacy of the Trump administration's economic policies. Investors around the globe trust the Treasury market because of its utility as a safe, liquid, and reliable store of value. Treasury securities are used for a wide variety of purposes in the financial system, including as a vehicle to finance the U.S. government, as a means for the Fed to implement monetary policy, as an asset for global investors, as a high-quality collateral for a range of different transactions and institutions, and as a reference benchmark for a wide variety of other borrowers. Daily trading volume for U.S. Treasuries averages around $1 trillion per day, and that's just in cash securities. Volumes in associated derivatives represent another major source of liquidity. During periods of market volatility, volumes in the Treasury market increase substantially. When markets continue to facilitate effective risk transfer despite unexpected events, that is a sign of things working. Having traded many different markets across the world throughout my career, it is moments when markets stop trading that most concern me. It is impossible to eliminate market volatility altogether, and that's why our goal must be to ensure a robust and resilient market that can withstand volatility when it inevitably arrives. To that end, Treasury is pushing several forward-thinking initiatives to strengthen the Treasury market. This includes the Treasury buyback program, which is an important tool in supporting market liquidity. While the program has been a success so far, we continue to look for ways to improve its efficacy. We have already expanded the size of the long-end operations in the Treasury buyback program and will expand the counterparty set in the first half of next year to continue building on the progress we've made. Treasury is also supportive of reforms to the enhanced supplementary leverage ratio, or the ESLR. In its current form, the ESLR risks becoming a consistently binding constraint rather than a backstop to risk-based capital requirements. That can distort banks' incentives to engage in low-risk activities such as Treasury intermediation. The ESLR must be improved to prevent this distortion. Expanding central bank clearing is also key to strengthening market. The SEC is currently leading an effort to expand central clearing in the Treasury market, which will enhance resilience, expand netting opportunities, and standardize risk management. This effort also supports competition in the marketplace as several central counterparties are launching new business lines to facilitate the expanded clearing activity. Demand for U.S. Treasuries remains as strong as ever, and these strategies will help us feed that growing demand. But equally important is maintaining Treasury's regular and predictable issuance framework. Our guiding principle at the Treasury Department is to finance the government at the least cost over time. The phrase "over time" acknowledges that Treasury issuance decisions are not to be made ad hoc, but rather as part of an overall strategy to accomplish our goals over the long term. And the regular and predictable issuance framework has proven to be the most effective means of achieving those goals. Although Treasury has regularly sold Treasury bills for nearly 100 years, it generally sold coupon securities on an ad hoc basis prior to the late 1970s. At that time, the rising federal debt burden rendered the previous ad hoc approach infeasible, and Treasury adopted regular offerings of coupon securities that have continued to this day. Thus was born the regular and predictable issuance framework. There are manifold benefits to this framework. First, Regular and predictable issuance promotes transparency and investor confidence by giving market participants a clear, consistent auction schedule. The single price auction format further supports strong participation and fair pricing. Second, by spreading maturities evenly over time, regular and predictable issuance limits rollover risk and avoids large concentrations of debt coming due all at once. Third, it reduces supply uncertainty and the risk of a market premium that could arise if investors' unexpected shifts in issuance. Finally, regular and predictable issuance reinforces Treasury's role in setting the global risk-free rate, providing a reliable reference point for other borrowers and financial products. To implement this regular and predictable framework, Treasury sells all its securities at a regular cadence and sizing based on a transparent schedule, and it adjusts coupon issuance gradually over time. Gradual adjustments are more important for these securities because of their duration. Our guiding lights in thinking about appropriate adjustments are durable trends in investor demand and Treasury's assessment of the issuance mix that best achieves its low-cost borrowing goal. In making these decisions, Treasury stays in close contact with investors, utilizing bilateral engagements with many of you in the room here today, and it solicits the advice of the Treasury Borrowing Advisory Committee and the primary dealers. When borrowing needs change quickly, bills are our issuance shock absorber. Because we want nominal coupon securities to adjust gradually, bills play an important role in managing changes in borrowing needs that are seasonal, short-term, or unexpected. Bills also facilitate flexibility, particularly in times of uncertainty and amid quickly evolving changes in demand profile. Importantly, being regular and predictable does not mean that Treasury's issuance policy cannot or should not evolve as investor demand changes. If our borrowing outlook changes, so will the amount we issue. And if structural demand for certain products or tenors evolves over time, we will be responsive and adjust how we allocate issuance accordingly. For example, we are closely monitoring growth in money market funds and the stablecoin market, which are both large investors in Treasury bills. Money market funds are now valued at about $7.5 trillion, having grown by nearly $1 trillion in the last year alone. The stablecoin market, meanwhile, is valued at around $300 billion and could grow tenfold by the end of the decade, thanks to the innovation made possible by the Genius Act. As money market funds and stablecoins grow, so too will the demand for Treasury bills. In addition to growing demand for Treasury bills from money market funds and stablecoin providers, we are witnessing increased demand from banks as they shake off the excessive oversight that has held them back. Since the start of this year, bank portfolios have expanded their Treasury holdings. Additional reforms, including the potential ESLR reform I mentioned earlier, could further accelerate this process. As Treasury watches these trends play out, we will assess whether they are structural or temporary shifts, and we will adjust our long-term issuance plans accordingly. For Treasury auctions to be successful, we need to be attentive to market participants, but we will not change our overall protocols. We will remain analytical in our decision-making, adjusting issuance gradually to avoid market disruptions. We'll provide public forward guidance to the extent practicable, and we will regularly canvass the market for feedback on how our issuance decisions are being received. Now, let's look to the year ahead. At Treasury, we have already provided forward guidance that we will likely not need to change coupon auction sizes for at least the next several quarters. Existing financing capacity from current auction sizes and robust demand in the bill market have given us flexibility to manage our upcoming potential borrowing needs. Recent developments have also given us additional time and flexibility before we need to make any such decisions. These developments include the reduction of the national deficit and the FOMC's announcement that they will start purchasing Treasury bills with proceeds from their MBS holdings. At the most recent TBAC meeting, the committee determined that the current issuance mix is well positioned to balance a low cost of debt with the low volatility of a productivity boom. While keeping proper risk management in mind, our long-term economic outlook is consistent with an expectation of increased productivity stemming from an additive boost of artificial intelligence, increased investment in the United States, and elevated capital expenditure investment. As such, we will continue to monitor trends in investor demand, and we will continue to consider where and if additional issuance could best achieve Treasury's debt management goals. When and if the time comes to make changes, we will be prepared, and we will socialize our plans with market participants. Now allow me to offer a few thoughts in closing. We are gathered this morning in New York's financial district, historically the beating heart of global capital. A few blocks south of here is the New York Stock Exchange, while today's venue is Wall Street, or maybe in a few years it will be Y'all Street in Dallas. My main audience is and will always be Main Street. I answered the call to serve because I wanted to help President Trump usher in a new era of parallel prosperity, a decade of economic expansion where Wall Street and Main Street grow together. President Trump's golden age stands to benefit Americans on every rung of the economic ladder, and maintaining a strong and robust Treasury market is critical to that goal. Properly managing our nation's debt is a solemn responsibility that will affect generations of Americans to come. That's why maintaining a healthy Treasury market and strengthening it even further is my foremost responsibility as Treasury Secretary. Treasury is committed to safeguarding the world's benchmark for stability while ensuring that the American people can borrow, build, and thrive. By keeping the risk-free rate low and the Treasury market strong, we are making America affordable again, and we are ensuring that our nation's prosperity endures far beyond our own time. Thank you for being our partners in that project. Thank you.
Thank you, Secretary Bessent, for those remarks. At this time, we're going to jump right into the second panel, which will focus on recent enhancements to the Treasury buyback program, and we will reserve some time at the end of the panel for Q&A with the audience. So for this discussion, I'll be handing things over to Hunter McMaster, who will be moderating the panel. Hunter is the Director of Policy and Planning at Treasury and also performs the delegable duties of the Assistant Secretary for Financial Markets. Prior to joining Treasury, Hunter was head of trading at Key Square and previously held positions at Morgan Stanley and Goldman Sachs, where he focused on foreign exchange and interest rate markets. So please join me in welcoming Hunter and our esteemed panelists.
Good morning, everyone. First and foremost, I want to thank the New York Fed for hosting. It's no small feat to organize this event, and for you all sticking around after hearing from President Williams and Secretary Bessent. Those were the interesting ones, but we're glad we're here. So I'm happy to be here today to discuss one of the primary innovations that the Secretary just touched on in Treasury debt management of the last few decades. That's Treasury buybacks. The goal of this panel is to take a deeper dive into the buyback program, its history, its objectives, how it differs from the Fed's programs, its performance to date, current features, and potential future enhancements. By way of background, the Treasury buyback program was introduced in May of 2024. The program aims to provide liquidity support for off-the-run Treasury securities, TIPS, and to improve Treasury's cash management. Liquidity support buybacks are intended to serve as an opportunity for investors to sell off-the-run treasuries that may be lingering on their balance sheets. By freeing up balance sheet, intermediaries should be more willing to facilitate risk transfer, which should provide more liquidity broadly for the market. Even just knowing that Treasury buybacks are upcoming should make dealers more willing to make markets for end investors. However, Treasury buybacks should not be confused with QE or open market operations. There are several important distinctions. We've been clear from the outset that we are a price-sensitive buyer, only accepting offers that are attractive for the taxpayer. If an offer doesn't appear attractive based on market pricing or relative value, Treasury will simply not accept the offer. As a result, Treasury may sometimes purchase only a small portion of the maximum amount, or sometimes purchase nothing at all, the key driver being the quality of the offers. Treasury doesn't have objectives like influencing the overall level of rates or changing the maturity mix of debt outstanding. Instead, the goal is to provide holders of Treasuries an avenue to exit positions, free up balance sheet, and hopefully improve liquidity provisions. The other buyback objective is cash management. Treasury can use buybacks to reduce the volatility of bill issuance when the cash balance is high. Traditionally, Treasury handles such timing mismatches between cash inflows and outflows by running the TGA higher or paying down bills. Buybacks give the Treasury a third tool to use excess cash to purchase coupon securities that are maturing in higher outflow periods over the next 2 years. In this way, buybacks reduce volatility in bill issuance and the TGA. Now, before I introduce the panelists, I want to run through some interesting numbers on the buyback program to date. Since May 24, Treasury has bought back a total of $239 billion across all buybacks. That's $113 billion for cash management and $127 billion for liquidity support operations. Treasury has received over $1 trillion of offers since buyback began over the course of these 91 operations. Treasury has received $340 billion of offers in cash management and $795 billion of offers in its liquidity support operations. And on this slide, you can see that we received the most offers in the cash management bucket, the long end nominals coupons bucket, and the short tips buckets. Now, to discuss this program, I'm delighted to be joined by 5 market experts. Seated with me are Jay Berry, who is Managing Director and Global Head of Rate Strategy at JP Morgan. His team covers U.S., European, UK, and Japanese rates, and Jay's expertise is rooted in U.S. rates, with a particular focus on the Treasury market. I have Rick Chan is here, who is a Managing Director and Portfolio Manager in PIMCO's Newport Beach office, focusing on global macro hedge fund strategies and relative value trading in dollar rates. And then I have Dan Kowirvia, who is the Managing Director and Global Head of U.S. Treasury Trading at BMO Capital Markets, where he oversees the trading of Treasury securities across the curve while making markets in longer duration bonds and strips. And Scott Rofi, who is Global Head of Rates, Macro, and Commodities Risk at Millennium, where he was responsible for managing risk in the Millennium rates and macro businesses. And last but not least, Anshul Sehgal, who is co-head of U.S. interest rate products trading and a partner at Goldman Sachs. And for the audience, at the end of this, we'll have time for Q&A. Gentlemen, thank you for being here and participating. So let's start with a high-level question. I'll give this to Anshul and Dan. How would you describe the effectiveness of the buyback program so far? Does it free up balance sheet, ultimately making for a more liquid market, as I described earlier?
From our vantage point, it absolutely does. Based on our internal metrics, it has led to tighter bid-offer spreads on off the runs. It has led to more liquidity around the buyback program and off the runs. But of course, as you pointed out, the real price for the market here is the balance sheet, that stock dealers get to basically rotate out of it. That creates headroom for dealers to provide more liquidity to market participants, which is just straight up good for the system. May of this year, there was an IMF working paper on that tried to quantify the impacts of these things. Again, the problem with that is that the counterfactuals, not easy to figure out, but they go through a statistical exercise. They find that all of these things are also borne out in the data itself. So from our vantage point, it's been a material success. So.
Yeah, I mean, I would agree there. I think if you look at measures of off-the-run kind of dispersion across the curve, they've greatly improved since the buyback program, especially since the long end increases in the summer. You had issues, parts of the curve that were, used to be very volatile, trade, much more stable. The 20-year point in the curve has been relatively stable on the fly. So really, as a dealer, knowing that the Treasury is there to support and be involved in sectors and certain CUSIPs, it really has helped with the turnover of those issues. So I think, as a dealer, knowing that there is involvement in certain CUSIPs, there is volume trading in certain CUSIPs, it helps us to, make the appropriate prices and be an intermediary. Maybe not necessarily directly reduce balance sheet. Dealer balance sheets are still relatively elevated, but it allows us dealers to allocate balance sheet where we want and not for off-the-run securities that we might not want to keep on sheet for longer periods of time. So I think I would agree that so far the sizing, the cadence, and kind of the way the program has been run has been very effective from a liquidity support basis across the off-the-run curve.
Yeah, I think for dealers, it's important to have a backstop, but not be the Treasury, be another market maker. So it's like liquidity provider of last resort when it comes to balance sheets.
Great. Thank you. That's good to hear. And more recently, we've announced a larger size of liquidity support operations, larger size of cash management buybacks. We changed the tip bucket a bit, changed the frequency of the long end buybacks. And then, as the Secretary mentioned, we're going to allow a limited number of non-primary dealer counterparties with direct access. Any reaction to these announcements from the group?
I'm happy to step in and start. I think both programs, Hunter, the program changes make sense. If I think first about the cash management program, and Secretary Bessent just said this in his speech, that bills are the shock absorber for financing for Treasury to meet seasonal variations in cash flows over time. And it's just notable to me that there's an increasing seasonality to your cash flows. And when we see this year with the strong surplus months that were run in April and June and September, versus the deficits over the rest of the month. So to the extent that this can smooth out that supply of bills at a time when the money market fund industry is at $7.5 trillion that the Treasury Secretary talked about, I think is very important. And knowing that this is probably going to increase over time, given the variation in seasonal financing needs, is very important to increase those sizes. With respect to the liquidity support program, I think it was evident that since the program was first introduced in the spring of last year, that conditions had changed because dealer positions had risen about 35%. And that was in excess of the growth of the Treasury market between, call it, mid-24 and mid-25. So that rise in dealer inventory, while it has been amid sort of strong market liquidity, it made sense that some program changes were made. And the stylized buyback score that was introduced at the July refunding, I think, gives us a transparent way to look into this. So to know that offer to max ratios have been increasing at the long end of the curve, the same place where inventory had been increasing, there's some information value in that. But all the while that we could see that dispersion, as Dan talked about, has been on an improving trend, and that there's no sort of increased noticeable trend for liquidity preference through greater demand for on the runs versus off the runs, that when you put the pieces of the puzzle together, the growth in inventory at the long end, seeing offer to max ratios rising there, necessitated a change, and you've adapted to it. So I think they're sensible and they're transparent.
Yeah, I think that's the long end is where the friction binds, and therefore, the markets, especially for the liquidity support part, that's where the changes we made in July made a world of difference. And again, as Treasury's outright issuance in nominal terms goes up over time, the Treasury would likely need to adapt again in the long end because that is where the friction's binding.
Yeah, and I would say that if you take a look at the long end, there's been a lot of concentrated issuance that is sitting with the dealer community. And by expanding the program to kind of, more participants, specifically us, here on the buy side, it allows for greater CUSIPs to be involved. And I think that is very helpful because it increases liquidity where, if you only have, in extreme cases, one dealer, you're only susceptible to basically offering what your balance sheet is. If you open up to a larger marketplace and more bonds are ending up much more on the buy side, even though dealer balance sheets are increasing significantly, the buy side foreign investors are increasing even at a larger rate. So having that access to more CUSIPs, specifically in the back end, which might not be as notional intensive, I think is extremely helpful.
Great. Anything else? Well, we'll get to the long end. I know that's what everyone wants to talk about, but let's stay on the front end for a second. So Anshul, Dan, again, going to the dealers, can you walk through kind of how the cash management buybacks have helped the bill market specifically?
Yeah, sure. Like the stats speak for themselves. The WAM of bill issuance has been much more stable. CMBs have been, the volatility in the issuance of CMBs has gone down. TGA balances versus target, if you look at that spread, that's been much more stable. So it's a necessary, for the cash management buybacks, it was a necessary step for the Treasury to have this tool in their toolkit. So again, it's been very successful, but then the sizing of the program would likely need to keep pace with the issuance outright. I don't know if you'd agree.
Yeah, I mean, I think we generally agree with that, and that the fact that it helps us manage our cash balances when we need to, and kind of make sure that we're taking the right and off-laying the right CUSIP risk. It's also kind of helped smooth out some of the short coup curve and kind of made it a little more, a little more regular, a little more, like, again, less dispersion. And I just think it's been a benefit for the market at current sizing, and helps the dealer community, with the operations.
It's the 12-month to 18-month sector where there is like market segmentation, because money market funds won't go there, and they basically end up clogging dealer balance sheets. So if there's any tweaks to be made from our vantage point, it would be basically addressing that gap a little better.
Great, thanks. Okay, so now moving on to liquidity support operations. We obviously increased the frequency very recently, but going forward, do you think the program should be bigger? What are the pros and cons of going bigger? Keeping in mind that, we have to fund buybacks.
So these are cash ops. So in that sense, if the size of any one buyback grew, then the duration that basically gets removed from the market goes up. So that needs to be a consideration. But I think if you look at bid to cover ratios, the market is saying that it needs more support in a backstop, again, not another market maker in the form of the Treasury. And Rick brought up non-primary dealers. I think that makes a lot of sense as well. It's a delicate balance between the Treasury basically being a liquidity provider, or a liquidity provider of last resort. I think so far the Treasury, by being very methodical and considered in how it's approached this, has struck a very good balance. So I think that would be important. But the intent, or from our vantage point, our recommendation would be for long-end buybacks to go up, given that that's where frictions are binding.
Yeah, you sort of got to see the market debate the point about size around the time of the July primary dealer survey and the third quarter refunding announcement. So as you mentioned, the size did go up, and it met demand, which is, I think, a primary objective of the program. But I would say the amount by which it went up was sort of well within the range of what market participants would have forecasted, ahead of the increase, but it wasn't at the top end of the range. So I would say that's another piece of evidence that the program could probably grow without really surprising the market or being out of line with demand. Jay mentioned the price-based metrics that people track as part of the scoring. That's also obviously factors in. As the secretary said, the taxpayer should get some savings out of the program. I would say that buybacks have sort of taken place over a time in markets where like measures of relative value of off-the-run securities are sort of middling. And so, as you go through inevitable ebbs and flows of those relative values, if prices change in such a way that shows that the market has more demand for off-the-run liquidity, I think that's something that could be responded to, in a regular way. Anshul mentioned the WAM. The Treasury Borrowing Advisory Committee did some work on showing various effects on the WAM for various sizes of the program. In its current calibration, plus or minus small changes is a pretty negligible annual effect on the WAM relative to past historical standard deviations of changes in the WAM. So I think that's also supportive of some flexibility on the size. But as you said in the question, the other side of the ledger is obviously auctions. Auction sizes are an order of magnitude larger than any individual buyback, and so that's part of the health monitoring of how big the program should be. You want auction stats to look healthy, and you want them to look healthy even in times of stress. And I think thankfully, we had a couple of bouts of higher volatility this year. And I think both the buyback program and the auction stats were pretty healthy running through those. And I guess the last point I would make is as you open the program up to more participants, it may be the case that we find that there's growing demand on both the auction side of the ledger and the buyback side of the ledger just by virtue of more participants having more demand for both programs. And I think that's something that Treasury can learn from as it evaluates that, and will go into thought processes about the future size of the program.
Great. And sort of getting into the weeds, do you have a view on the expansion? Would you prefer frequency or just size of the program, or size of an individual operation?
I think it'll be more helpful to basically maybe have the program be a little more granular. Rick mentioned that specific QSIPs matter a lot, so that'll give more feedback, because right now we only get the stats by bucket. So if the buckets were like broken down a little further, but you'd have more frequent programs, and then the overall size was greater through that process, then I think it would give better feedback to the market. The market likes the Treasury being regular and predictable. Over the last year and a bit, the market's gotten very comfortable with the idea of like where you need to show an offer to get done on the buyback. That's very helpful for the market. The Treasury's, again, a backstop bid, not a firm bid at the market level, but that clarity helps a lot. So I think the more stats the Treasury can expose, the more granularity you can have, the more the QSIPs that, again, you have a lot more visibility than the rest of the market participants do, would basically inspire more confidence in the program. And adding non-primary dealers, as you and Rick both mentioned, again, makes a lot of sense. But again, considered slow move in that direction is what the market's looking for in my mind.
Okay, so maybe taking a step back, we walked through how dealers access the program, or for reasons the dealers access the program. Can we go through how other market participants use the program as a whole, maybe from relative value or duration buyers?
Yeah, I would say that, right now, for us to access the program, we have to do it by a dealer. And I think, one thing that's kind of, underappreciated is just the operational difficulty of auctions, buybacks, and just the, call it, the micro nature of executing treasuries. And I think for us, the difficulty, given all the regulations, if we were to go to any, one of my colleagues here, for us to access the buybacks requires a big, long lag. And when you're trying to rebalance real money portfolios where there are flows that come in and out of certain complexes into others, you have to transact in the market. And it's very difficult to do so because you're basically having an order that is not linked to the current price, upwards of 30 minutes ahead of the actual operation. So, there's kind of a winner's curse where if the market moves in one direction, you're kind of guessing. Mm-hmm. And I think, the operational inefficiency, just like, with treasury auctions, having that direct access both alleviates that operational burden for the both of us, both the sell side and the buy side. And if you take a look at the auction stats, direct participation, where timing, becomes less of an issue because there's less intermediation, I think helps with that process. So I think, for us, it's using the tools to basically manage essentially cash flows within one business to the next business. Because if you take a look at, the real money mutual fund model, if you put your money in one, type of product and move it to the other, it requires transactions of off-the-run securities in order to kind of facilitate that cash movement.
See.
Yeah, I mean, the program is a multi-security, multi-price program, and so that just makes the operations even more challenging to, if people want to exhaust inventory flexibly across a number of different securities, maybe at different prices. It makes the operational challenge for my dealer colleagues on the panel certainly harder to handle. And at some point, there's just a limit for how much you can handle for multiple clients and multiple securities at the same time. Obviously, technology helps there, but you need to safeguard and protect operations and make sure that everything is done precisely. And so that creates, a need for some protection. I think the expansion of participants will cut through some of that and will provide, maybe more confidence for the buy side to participate. I think maybe the only other point is, in off-the-run securities, the pricing is very transparent, but the point of the program is liquidity, And along with like need for liquidity goes potentially, especially if somebody wants to trade something in block size, that they may want to protect the information for the market, and that might be something that's currently a barrier for buy-side participants to engage that might go away a little bit with the change in the program.
See. Well, we're kind of jumping ahead a bit, but as far as alleviating some of those concerns that you mentioned, as far as accessing the program, whether it's call it a latency of the order difficulties, do you have any enhancements in mind that Treasury could implement?
I would say, I appreciate the complexities of the cash flows of a large end user organization in trying to access the buyback. But, for instance, at BMO, we try to make it very seamless for the customer. We've built tools that, a customer could give us an order either with their own outright level in mind or on a spread to the on the run. And then we would be tasked with striking the on the run as close to the operation as possible. Similar to any market trade, there is, of course, market risk in any outright transaction. Any market trade where there's duration involved, there's going to be some outright risk. But in general, we've found that our counterparties trust our kind of take on the market and our strike of the market as close to 2 p.m. as possible. In terms of enhancements, maybe there could be some type of facility where the Treasury would strike the mid price, but I think that assuming everything is operationally sound, which in our experience it has been, the Fed trade system is very responsive and very kind of easy to use with the right tools. I think that our customers and the dealers in general like having control over kind of how and where they strike the market to a degree. So, there might be some that prefer to have the Treasury take care of the strike, but I think that in general, participation in the operations is somewhat dependent on the ability to control those factors to the best of their degree. I guess outside of maybe some type of volatility kill switch post 2 p.m., but then it starts to get a little messy. But we haven't really found any great issues with that, though the market hasn't been super volatile around the operations.
I'd like to point out at Goldman too, we've made many improvements for the client experience. It didn't stop the two gentlemen there to basically want to deal with you directly.
The Q&A is going to be all the other dealers saying they've done the same.
I mean, one idea is to basically have Treasury do that, where Treasury buys the off the run and then sells the on the run, because essentially that's in the end that's kind of what happens, right? In order to kind of like have one less step in the process, if somebody's trying to transform their portfolio into more liquidity, being a liquidity operation by exchanging off the runs for on the runs directly helps kind of do that with less friction within the system.
Yeah, no, this is feedback we've heard before, and I'll point out that this is something that would take us considerable time to implement, but something that we have tried to think about. I guess, Dan, as we try to think about going from a cash for securities to a switch facility, in your experience, what were the headaches around building that that you would be cognizant of?
Yeah, I mean, listen, a switch facility, setting aside some of the exact funding cost and kind of the cost benefit analysis of the Treasury, that's not exactly my job. But I think that you would get a certain contingent of customers and dealers very willing to participate in a switch facility. However, again, I think that the ability to control either the strike or the ability to change the level or the ability to manage the resulting duration from that trade makes the program more attractive, right? Treasury has already benefited from the program in that the prevailing traded price are well below the market mid at the time, especially in the long end. So I think that, kind of if it's not necessarily broke, maybe don't fix it yet. I think that it's worked from a kind of, a level perspective and a balance sheet, turnover perspective. So, while some customers might prefer switch, I worry that it would scare more away or make it more difficult for some to submit, with knowing that they wouldn't have the other leg of the trade.
Yeah. Great. Okay, well, I want to pull up some stats for the long end bucket. If we can get them here. There we go. So market participants, as you all are well aware, that long end buybacks are well oversubscribed. This slide on the screen right now is the 10 to 20 year bucket. In a few minutes, I'll show the 20 to 30 year bucket. But the data show that total accepted offers in these sectors are highly concentrated among a small number of securities. So what might explain why certain securities are more aggressively offered, and why is this dynamic prevalent in the long end versus others?
I'll give my view very briefly. Market segmentation. The long end was large. Essentially, if you're going back 15 years, long end was bought by the pension and insurance sector, but because of demographic changes and a whole host of things that transpired, especially on this side of the pandemic, the boomers basically went from being working towards retirement and actually having retired. The market segmentation was such that the buy funds and dealers basically inventory a lot more of the long end. And that is why the concentration of issues as the Treasury took up the sizes across the curve essentially meant that these market participants ended up owning a lot more of the long end. And that's why these dealers are much more acutely sensitive to price fluctuations, volatility in the market. They're all levered, much more levered than pension and insurance companies are. And as a consequence, you see much more activity, and they basically end up being offered a lot more.
I think the segmentation, but also the fact that the introduction of the 20-year new issue at a time when right after that issue sizes needed to increase mean that you have some fairly large issue size bonds in the market. They happen to overlap in duration with another cluster of off-the-run 30-year bonds, and I think the long end in general has a property where the securities in sort of the center of they sort of bridge liquidity between the 10-year point, the 10-year on the run, which is highly liquid, the 30-year on the run, which is highly liquid, the classic bond contract and futures, and the ultra long bond contract. There's a lot of duration space between the liquidity points, and so these bonds historically have vibrated with higher volatility outright and in relative value. And so that means that people who hold them, who have a desire to turn them over for one reason or another, might avail themselves of the program in larger size.
And I think just to build on what Scott said, I think the sizing matters too, because if you look at the securities in the 10 to 20 year bucket, which have been the biggest participants in the operations, those are also the largest 20-year issues. I think if we remember, when the 20-year was introduced, a lot of the guidance given was that maybe it should be sized somewhere between 75 and 80% of the 30-year bond. Instead, at onset, it was sized the same size as the 30-year bond. So those issues in the 2041 sector are unusually large, and I think that's why they have been the largest offers into the operations as well.
Yeah, I would agree. Those are, kind of hit very similar points. But, the Treasury has taken steps to kind of, reduce the issuance size in 20s and stabilize the point. But that doesn't get rid of the glut of off-the-run issues. Nearly $400 billion of float in 2040, 2041 20-year issues, right? So because of that large float, naturally some bonds might trade cheap, and there might be more dislocation in that area because of the large amount of free float, which as volatility comes down, as the market stabilizes in general, we're near multi-year lows in rates vol, the kind of highly levered community as well as dealers try to take advantage of those dislocations, right? So you're left with a concentration of those specific issues across dealer and hedge fund balance sheets. And I think because of the duration, the DV01 size of these long end ops and the relative anonymity from cleaning up large positions in one fell swoop,